My name's Ethan Braid. Today we're going to look at actual results for two very popular balance funds going back to the year 2000 and distributing 5% every year. You really want to watch this whole video and see the end because the difference in the results is just unbelievable. Once you watch this video, you're going to say to yourself, wow, it is really important which fund I use, not just what spending strategy or what asset allocation. Our first illustration will be for the Vanguard Balanced Index Fund, making $1 million investment on January 1 of 2000, distributing 5%, $50,000 in the first year, and growing that distribution by 3% for inflation every year thereafter. What we see right away is that we ran out of money in 22 years. Here are the numbers. Starting January of 2000 with $1 million, taking $50,000, growing that by 3% for inflation. In 22 years, we've run out of money. Two things that I want to point out about this Vanguard Balance Fund. One, it's very inexpensive. They only charge 0.18%. Two, notice these returns in 2000, 2001, and 2002. Minus 2.17, minus 2.83, minus 9.50. Keep that in mind when we look at this next fund. Our second fund is the Fidelity Balanced Fund. Same asset allocation as Vanguard at 60-40 between stocks and bonds, but look at the difference where we're starting on the same date, January 1 of 2000, exact same distribution pattern, same dollars, but we're ending with $1 million, which is incredible. And this fund charges more than double the fees that Vanguard does, which is also very interesting. They're charging 0.51 for this Fidelity Balance Fund versus 0.18 for Vanguard. So it kind of throws shade on the argument for low fees. Clearly, the folks at Fidelity have done something good here over the last 23 plus years when compared to the Vanguard Balanced Indexed Fund. Here are the numbers for the Fidelity Balance Fund. Same start date, January 1, 2000, $1 million going in, same dollars being distributed out. But here's where the difference is. Fidelity made money in 2000 and 2001 while Vanguard lost, and then Fidelity had a loss in 2002, but a much bigger return in 2003 when compared to Vanguard. So by having better risk management at the onset of the recession, Fidelity's long-term performance becomes much better. And this, to me, demonstrates the importance of having a solid investment strategy from day one when you retire, because if you get hit with bad timing and you have a poor investment strategy, it can really mess up your retirement, as we see here. At the end of nearly 24 years, the Fidelity Fund is a little bit more ahead of where you started, and you're now spending over $98,000 per year because you've grown your 5% distribution for inflation this entire time. Now let's analyze a comparison table with the final results. Right away, we can see that there is a very big difference in fees for these two funds. The Fidelity Balance Fund is more than double the cost of the Vanguard Fund, and yet the Fidelity Fund finishes over $1 million ahead. Why is that? Fidelity clearly had better risk management going into the recession of 2000 and was able to participate in the upside after the recession. It made a big difference in their long-term results. This illustration really makes you question just how important are low fees. Another important lesson that we can pick up from this comparison is that not all balanced funds are the same. Clearly, there was a very different long-term performance between Fidelity and Vanguard, even though these are both in the same category and both are labeled as 60-40 balanced funds. The intent of this video is to get you thinking about the importance of investment strategy selection, lining up your asset allocation, and understanding the risk management techniques that your investment manager or managers are using. I'm not recommending either the Fidelity Balanced or the Vanguard Balanced. This is not a recommendation or solicitation for either of these funds. I'm trying to create an awareness that not all balanced funds are the same and fees may not be nearly as important as you think. I hope this video was helpful. I hope this video got you thinking. Please share it with your friends or other people that you think might benefit. And I hope overall that this video helps you improve your family's financial plan.